Welcome back to Switzer. My next guest is here to tell us if it's now a good time to buy or not. My guest is David Buckland, who works with my old buddy Roger Montgomery, and he's in our Sydney studio. How are you, David?
Good, thanks, Peter.
Now, mate, last time Roger was on the program, he said to me he was holding cash, and when that market started to fall, I was wondering whether you guys are out there buying stocks. Well, have you been?
Look, we've dipped our toe into the market. Peter got down obviously on Tuesday to the 46.30 mark after falling about 600 points. It's obviously bounced 150 points in the last few days, but to be honest with you, Peter, unlike your last speaker, we're still relatively nervous about the whole China story. I mean, commodity prices calendar year to date are off anything between about 12 and 30 percentage points. The Shanghai Composite Index on Tuesday was off 70% from its all-time high of 6 3/4 or 5 3/4 years ago. So I don't know how, with those sorts of statistics, one can be sort of overly positive on the China story or the commodity story. So what we've been doing, Peter, is we've been buying very selectively high-quality industrial stocks. And stocks like, for example, Ainsworth Gaming, Amcom, ANZ, there's three A's that I'll throw out there that we just dipped our toe in the water. But I'd have to say that what we've seen with this pullback is that the rubbish has pulled back, but the high quality hasn't pulled back very much at all.
No. So ANZ, you've picked up one of the banks. What's your feeling around ANZ?
Oh, look, for us, it's all just about valuation, and that was the one bank that came back with this decline to a level that we thought was sort of, an acceptable price. Despite, as I said, Peter, despite the 600-point decline over that period from mid-May till Tuesday this week, we really had trouble finding high-quality stocks coming back to the levels that we thought were sort of great buying opportunities. They were just, I'll call them just fair buying opportunities. At 5,200, many of the stocks that we follow were just a bit too hot in price.
Now, David, Roger and I have discussed, debated, talked, chatted for a long time, and I never ever necessarily see him as being an expert on the big macroeconomic picture. He's an expert on understanding companies and valuing them, and so my question is, when you're gambling on what's going to happen in China, in a sense, it's a gamble for all of us, isn't it? All the economists are guessing. We don't know which way it's going to go. Is that part of the reason why you're hesitant?
Well, that's right, Peter. I mean, we gamble on business models, and what we basically argue is if you don't know what the price of your commodity or your good or your service is going to be in 6 months' time, then how on earth can you value the company? And all I'm simply saying, Peter, is that if you're a copper producer and copper's down 16% in the last 6 months, or you're an iron ore producer and iron ore's down 20%, or you're a silver producer and silver's down 38% in the last 6 months, then all I'm simply saying is that to invest in a copper, an iron ore or a silver stock is nothing more than speculation. What we like to do at Montgomery is we like to buy high quality industrial stocks with excellent balance sheets where they have a very, very good understanding of what their average selling price is going to be in 6 or 12 months' time and what their volumes are going to be. And by doing that, you understand the economics of the business. By understanding the economics of business, you can actually value the business with a degree of accuracy, and then you can actually step back and say, is the price quite cheap relative to that valuation, or is it expensive to that valuation? You're not just sort of going to Randwick and speculating.
Okay, let's look at Ainsworth now. Ainsworth shouldn't be affected by China unless they're selling poker machines into the Chinese economy. Why do you like Ainsworth?
Oh, look, for us, Peter, it's about quality of balance sheet. It's about reliability of cash flow. It's about recurring income stream. It's about intrinsic value rising, and it's about the share price relative to that valuation. So when that stock got down to 380 or 360 early in the week, it just sort of started ringing a bit of a bell for us from a valuation viewpoint.
And what are the critical issues for a company like Ainsworth? Is it consumer sentiment? Is it economic growth? What are the drivers for a business like that?
Look, it's really replacement of machine is the economic driver. And what's clearly happening is if you've got extremely good technology, then what happens is when there's a replacement cycle going on, you end up at the top of the the top of the tree in the replacement cycle, and that's really the driver.
Okay, and the last A you gave us was?
Oh, sorry. Then there was Amcom, and then there was ANZ for my 3 A's.
Yeah. Quickly about Amcom, just a quick summation on that.
Well, a high quality, a small telecommunications company, very big market share in Western Australia, Northern Territory, specifically Darwin, and a little bit in South Australia. And as I say, with the weakness that we saw in that particular stock, we just felt again high quality business, good balance sheet, good recurring income stream, and we just felt that with that pullback, it sort of started hitting the share price was below the intrinsic value we think that Amcom is worth.
David, thanks for joining us on the program.
My pleasure, Peter.